Hello everyone. Now I'm gonna introduce the final project of our 534. So the theme we have chosen is the journey of exploring quantitative trading. So in this process, we'll first explore how to use the mean variance model to construct an investment portfolio by simulating the process of quantitative trading. At the same time, we will have an understanding of the process of quantitative trading, about how to do the coding stuff, or how to choose the stock, and how to change the proportion of each stock. So the member of our group include me, Kent Zhu, and Si Liang, and Jiaxia Li. Okay, so next I'll introduce our model in the project. So first is the mean variance model. It's kind of portfolio selection theory that we learned in the class. So the core idea of this model is that we should consider the two main factors when choosing a portfolio. So first is the expected return, which is the mean, and the risk, which is the variance. So this theory provides a basis for us to determine the weight of our portfolio. So then is the multi-factor model. It's for the quantitative trading. So the multi-factor model is a very important model in the fields of quantitative investment. This model explains the return of securities by introducing multiple factors such as market value, profitability, and the risk level. So these factors are mainly divided into two categories, the fundamental factors and the technical factors. Unlike single factor models, multi-factor models consider multiple factors that may influence the returns, providing a more comprehensive perspective. So, due to the fact that the multi-factor models is one of the most typical models, we choose to use this model in this project. Then, then we have some other requirements for this project, mainly focused on simplified exploration. So firstly, there's a requirement for the investment that our investors need to fully invest all available cash into the investment portfolio. And then is the no short selling strategy, so which does not allow short selling of stocks when constructing a portfolio. So this strategy simplify the investment process and reduce operational complexity and risk, and is suitable for our new investors, which is unfamiliar with the quantitative trading. Then it will be the objectives of our project. So our objective is to reach highest expected return. So it will be a backtest, and the interval of our backtest will between the January the 1st, 2020 to uh, May the 1st, 2020. And the benchmark for our comparison is the yield of Shanghai and Shenzhen index. So our research mainly focus on Chinese stock market. So we will choose the Shanghai and Shenzhen index for the benchmark. And then it's the research goal. So our research goal is to maximize the returns and surplus uh, of our portfolio. It should be noted that our selection of the backtesting period is was affected by the discontinuation of the free simulated trading function on our platform, which is the Resquant platform. Um, so the Resquant platform stopped the free backtesting from October the 31. 31st, 2020. So we only choose the January to the May in 2020.
Next, I will share our stock selection process through factor analysis. We use the structured approach to ensure that we capture the stock's value from multiple perspectives. And in our stock selection process, we take a data-driven approach, utilizing the factor analysis to ensure that we are able to fully reflect the stock's value. So we use the crossover method for single factor analysis, which is an effective way of filtering out irrelevant factors and identifying the signals that truly influence stock performance. We believe that the optimal number of factors is between 3 and 5 because this can avoid over-complexity and also allow for both depth and manageability. The trading tool that we used is the RiseQuant Factor Analyzer. This is a very effective quantitative analysis tool. So by using this tool, we analyze the information factors at a 5-day intervals. Our result shows the effectiveness of this approach. We identified 3 valid factors that cover various aspects of the stock. And these 3 factors are net asset profitability ratio, volume ratio, and turnover ratio. Next, let's look at the result of analyzing each factor separately. The first one is the net asset profitability ratio. It is equal to net profit divided by average total assets, which reflects a company's financial health and the ability to profit from its assets. As we can see from the table on the left, the information ratio is 0.57, which shows strong predictive quality and indicates that the factor is very effective in predicting stock performance. The standard deviation is 0.11, indicates moderate volatility. And the t-value of 2.27 indicates the statistical significance, and the p-value of 0.04 also confirms the effectiveness of the net asset profitability ratio, as it is below the traditional threshold of significance. As for the volume ratio, the information ratio value is 0.16, which is a little bit lower than the average value, but it also has some predictive ability. The standard deviation is 0.12, which implies that the inventory activity measure is reasonably consistent and reliable. And the t-value of 2.61 and p-value of 0.01 both enhance the significance of statistic, emphasizing the validity of volume ratio as an important factor in our analysis. And the third factor is the turnover ratio. This is a measure of how often a stock is traded, and it can reflect the liquidity of the stock as well as the market demand for the stock over a given period of time. The IR of 0.41 for the turnover ratio indicates the moderate to strong predictive power, and it is also a meaningful measure of market liquidity. The relatively low standard deviation of 0.06 indicates a high stability and low volatility for this factor. So after identifying these key factors, we applied a one-factor test crossover to narrow our focus to 10 stocks. So below are the 10 stocks we selected, and those stocks mainly focused on the biotechnology and pharmaceutical sectors. We believe this is highly relevant to our backtest period. So our backtest period is from January 1st, 2020 to May 1st, 2020, and it is coincide with the early stage of the COVID-19 crisis. So we believe the market demand for the medical supplies, the biotech innovation between that kind of period really grew sharply. So that's why our stocks are mainly focused on the biotechnology sectors.
Hi, I'm Eve, and I'm going to detail the meticulous process of determining the optimal stock weights for the portfolio. Our journey begins with the foundation of portfolio management, the daily stock prices. By accessing the ResQuant platform, we can view the closing prices of the stocks at our disposal, and we compare each day's closing price to the previous day's closing price to calculate the expected daily return. The difference relative to the previous day's closed price provided us with a percentage that adequately describes the performance of the stock. But how do we capitalize on the inherent uncertainty of the market? So we use the Monte Carlo method, a simulation that takes advantage of the randomness of the market, and it runs 100,000 times. This gives us a range of potential outcomes and weights distributions that reflect the diversity of the market itself. With this simulation result, we can weigh our portfolios by calculating average annual returns and annualized standard deviations. On the right is our scalar plot. This scalar plot represents the efficient frontier. And then to get the real stock weights, we use the Sharpe ratio, and we identify the optimal initial weights by selecting the point on one of the plotted data points that has highest Sharpe ratio. And now we can see the optimal initial weight for the stocks in the portfolio in the table. We can see some is about like the top one is about 28.35%, and most of this time are farm use secular stocks. Now we are using a rebalancing strategy underpinned by the Relative Strength Index, or RSI, a tool widely respected in the realm of technical analysis. Our initial weights, meticulously determined through the process I previously outlined, provide a solid foundation for this exercise. As market conditions ebb and flow, the RSI serves as our compass. While stocks RSI surges above 69, it signals an overbought condition. Conversely, when the RSI dips below 31, indicating an oversold state, we see an opportunity. Here, we strategically allocate 20% of our remaining cash to purchase these underweighted assets. And this is part of our codes. And next, Kent will introduce the backtest outcomes.
So after our coding part and simulation part, we finally conduct a backtest to verify our strategy performance from January to mid-May in 2020. So our strategy achieved an annualized return of 46%, which is mainly because the factor that we selected accurately capture the pharmacy and technical stocks. So these stocks had excellent performance because of the COVID in 2020. So we obtained the excess returns. And at last, thank all of you for listening to our project. If you have any questions, please contact us. Thank you.